Welcome back. In this session, we are discussing about the divisional cost of capital. So when firms evaluate investments, they often use their WACC as a discount rate. However, if a firm operates in multiple business divisions with a different risk level, using a single one WACC can lead incorrect decisions. So in this part, we will explore why and how firm adjust cost of capital for different divisions. The firm's overall WACC reflect average risk, but what if different divisions face different risk? Using the overall WACC for the all division can lead to bad investment decision. So each division should use its own divisional cost of capital instead of a firm-wide WACC. So just simple, higher risk division require higher return to compensate investors. Lower risk division require lower return since they are safer investment. So estimating divisional beta help firms assesses risk at the business unit level, but it is challenging due to the data limitation and industry differences. So here is two key methods. First is pure play method, and second is accounting beta method. So pure play method is first step, identify public traded company operating in the same industry. Secondly, obtain their equity beta, unlevel and re-level them based on capital structure. Finally, average this adjusted beta to estimate their division beta. But it also has challenges because the finding truly comparable firm is very hard because in addition, we have to adjust it for different capital structure and market volatility. So second way is accounting beta method. So this is step by step is first use regression analysis on divisional earning versus overall market earning. And then we can provide alternative risk measure based on financial statement rather than stock market data. But it also has challenges because limited division level finance data exists. In addition, there is accounting differences and there is lack of the real-time market sensitivities. So each method has pros and cons, so combination of both may better estimate. Okay, let's move on the next part. So when the firm evaluates potential investment, it must determine whether this project expected to return justifies its risk. But how do we measure project risk? So there is actually three key ways to assess the project risk. First risk, stand-alone risk. Second is corporate risk. Third is market risk. So each of these perspectives help the firm estimate the project cost of the capital and determine its hurdle rate. Hurdle rate means the minimum return required for a project to be accepted. So let's look at the first part, stand-alone risk. So this is the risk of the project. If it were the firm only asset, it measures variability of cash flow and it's often assessed using the standard deviation. So corporate within the firm risk, this risk consider how project affect the overall variability of the firm's return. So sometimes of the project risk. And third is market risk, is beta. It is also called the beta risk, and it measures project risk relative to overall market. So this is the most relevant measure for investor because it affects the stock price. So once we assess project risk, we adjusted its cost of capital. So let's look at the example. So firm division has WACC over 10% and assign project into risk category. So WACC is 10%, but for the low risk project, 8% hurdle rate. And average risk project, just the same with the WACC, 10% hurdle rate. And the high risk project is put the 12% hurdle rate. So the riskier project must clear higher hurdle rate to compensate for uncertainty. So setting the risk-adjusted cost of capital is subjective, but it is ensure better decision-making than using just a single WACC for the whole project. Okay, let's move on the next topic. So this is managerial issue and cost of capital. So the cost of capital is a crucial factor in corporate decision-making. However, some factors affecting the cost of capital are beyond managerial control, while others can be influenced by management. So in this session, we will explore 4 factors the firm cannot control, 3 factors the firm can control. Okay, 4 factors beyond the managerial control. The while firm can make a strategic decision, some external economic forces directly impact the cost of capital. First is interest rate. Interest rates are set by central bank and broader economy. When interest rate rise, the cost of debt financing increase, making borrowing more expensive. And second is credit crisis. The credit crisis occurred when lenders became risk averse. So it restricts access to capital. So this makes it harder and more expensive for firms to secure funding. Third is market risk premium. So market risk premium reflect investors' expectation for return on risk asset versus risk-free investment. So if investors become more risk averse, the required rate of return start increase, raising the cost of equity. The final thing is tax rate. Government policy on corporate tax rate impact after-tax financing costs. Since interest payment on the debt are tax deductible, so lower tax rate reduce tax shield on debt and also increase the cost of capital. Okay, let's look at the 3 factors within the managerial controls. First is a capital structure policy. The mix of debt and equity financing affect the cost of capital. Well-balanced the structure minimize the financing costs while maintaining financial flexibility. And second is dividend policy. The firm dividend policy impact investor perception and retained earning when influence the cost of equity. And third is investment policy, just as a capital budgeting policy. So choosing the right project directly influence profitability and risk. So it also impacts overall cost of capital. Okay, let's move on the next slide. Okay, so in this slide, let's look at the 4 critical mistakes to avoid when estimating cost of capital. One of the biggest mistakes is basing cost of debt on coupon rate on the firm existing debt instead of current market rate. So the coupon rate reflects cost of debt at the time of issuance, not the cost raising new debt today. So the relevant measure is YTM on current debt, which reflects market required return. So we need to use current YTM on similar debt instrument when estimating cost of debt. Second type of mistake is using historical stock return with current T-bonds rate. So when using CAPM, some analysts mistakenly use historical average return on the stock with the current return on T-bond. Okay, so it is incorrect. So why? Because historical stock return may reflect current market condition. So this is not reflect current economic condition and current market risk premium. So this current market risk premium should forward-looking, not based on the outdated average. So the other type of mistake is using book value capital structure for WACC. So another common error is using book value instead of market value when determining capital structure weights for the WACC. So why is this incorrect? Because book value, this is actually from financial statement, are based on historical costs. Do not reflect the current investor's expectation. So market value provides a more accurate picture of how the firm is actually financed. So finally, another mistake is forgetting the capital confidence comes from the investors. So finally, some firms fail to recognize the capital confidence that an equity represents investors' supplied funds, not just any source of financing. So some analysts mistakenly include account payable or accruals, a part of the capital structure. But this is not short-term debt because there is no interest. Also, this account payable and accrual is more about the net working capital. So there is operating liability, right? So not the investors supply the capital. So in this chapter, we discuss WACC. So weighted average cost of capital WACC is a crucial financial metric that represents firms' average cost of the financing through debt and equity and first up. So it serves as the benchmark discount rate for evaluating investment opportunity. Also, it determines firm's value and makes stressed financial decisions. So just think about the WACC is important because WACC is used as a hazard rate to determine whether a project or investment will generate value. If project expected return exceed WACC, it creates value. So we should be accepted, but otherwise it should be rejected. In addition, WACC helps in estimating firms' intrinsic value by discounting future cash flow. So it makes essential for investor, for analyst, and management. Also, understanding WACC allows firm is balance debt and equity effectively. So it ensures they maintain cost efficiency or risk optimize capital structures. So lower WACC means firms can finance its operation more cheaply, making it more competitive, while higher WACC signal is a higher risk and higher financial cost. So by accurately calculating WACC and avoid common mistake, the firm can make a better strategic decision and maximize shareholders' value and ensure long-term finance success. Okay, thank you for watching all this lecture video. And if you have any question, and let me know. Thank you. Bye.